There you go.
Hello. Hey everyone. My name's Adam. I'm a student here at UQ as well, and sorry about that. Still wanting to do it. Yeah. Oh jeez. Anyway, I'm a student at UQ as well, and I'm just here to briefly talk to you guys about an internship opportunity for those of you looking to get. Do you want to just skip the microphone? Yeah, so I'm here talking about the Achievement Program, which is a program run by the Chartered Accountants, Australia and New Zealand. Some of you might know who the Chartered Accountants are. Basically, the Achievement Program is a chance for students majoring in finance, accounting, economics, etc., business, to basically gain some paid experience over the holidays. So you can get between 3 and 12 weeks of paid work experience, and there's a wide array of firms that are taking part and hiring through the Achievement Program. So if you take part, you have the chance to be placed with firms like all the big four and a bunch of other mid-market, like mid-tier accounting firms, finance firms within Brisbane. So basically, if you guys want to go to this website, you can apply. It's a pretty formal application, similar to the applications that you'll face when you get into graduate recruitment. So you'll submit your resume, you'll go through an assessment centre, do your psychometric testing and video interviews, etc., etc. And if you're lucky, and you impress the staff, you'll get placed with a firm and basically be able to complete some work experience with them. So I'm sure you all know the importance of getting work experience as early as possible and getting some valuable experience on your CV. And basically, this is the best chance you'll get to do that before your penultimate year. There are not many programs that will take students who aren't third year, and that's why I recommend this one. I did it in my first year, but you can do it first, second, third, all the way through. And yeah, if you're just looking to break in and get your first sort of placement within the industry, definitely have a crack at this. Paid work experience, 3 to 12 weeks full time over the summer break. So there's also a couple brochures up here. There's not many, sorry, but basically, if you just type in the Chartered Accountants Achievement Program on Google, you'll be able to find our website, or you can take a photo of the slide here, which also has our website on it. You'll be able to find the Achievement Program and apply online. Basically, applications are due midnight on Sunday, so try and get them in early. And yeah, it's the best thing you guys can do for your future to start getting experience and start gearing up towards your penultimate applications. So yeah, and if you do really well in your internship, there is the possibility that the firm will choose to take you on a part-time basis throughout the semester as well. So definitely give it a crack, and yeah, we look forward to your application. So thanks a lot, guys.
Thank you. No worries. Okay, so can you hear me up the back? Yep, great. Okay, so today's the third lecture. Remembering that you have 4 topics, first, second, third and fourth lectures that will be covered in your online quiz. Next week is ECA holiday, so I'll pre-record the lecture for that day. So today what we're looking at is job costing. The last 2 weeks we looked at an introduction to management accounting, including the terms, so you should have a really good idea now about what management accountants do and how they differ from financial accounting. And then last week we looked at cost behaviours and cost volume profit analysis and operating leverage. So today we're kind of going back to the material that we started in week 1, and we're going to look at job costing. So we're looking at a specific costing system. And remember, in week 1 we prepared a statement of cost of goods manufactured and sold. So this relates directly to that material. So it's part of this second part of the course where we're looking at different costing systems. Today, job costing. Next week's recorded lecture will be about cost system refinement. So today we're looking at a very simple job costing system where we have 2 categories of direct costs, and then we have one overhead cost pool that we allocate to our jobs. Next week, we're going to be refining that system by introducing more allocation cost pools and rates. The following week, we're going to look at activity-based costing, and that's going to be the topic for your first case. Following that, we're going to look at process costing. So it fits together quite nicely. I'm just going to swap over now to the Echo system. If you have Echo on a smart device, it'd be great if you could go into that system so that you can respond to the MCQ questions if it works. Okay, that's not going to work. So today what we're interested in doing is have you understand these objectives. So why use costing systems? And we've kind of touched on this already. We need to be able to cost our product for external reporting. We have to be able to come up with a value for our cost of goods sold. We're going to talk about how to cost your product, and hopefully you're familiar with these terms. What's a cost object, how we accumulate costs in our accounting system, and then we allocate those costs either by tracing them or by allocating our indirect costs. So we're assigning those costs. And then we're going to talk about different types of costing systems, job versus process. And today we're going to do some examples where we use actual costing and normal costing. So we want you to understand the difference between actual and normal costing, as well as standard costing, which we will get to later in the semester. So then we're going to, in the last part of today's lecture, talk about different approaches to disposing of under or over allocated overhead. So when we use normal costing, we actually use a budgeted overhead rate, which means that at the end of the accounting period, we might end up with more overhead allocated to our jobs than we actually incurred. So just reminding you, during our first week, we talked about how we have these new inventory accounts that you learnt about in relation to manufacturing organisations. So we talked about 3 different inventory accounts, and we talked about the flow of costs, the inventoriable costs that move through those accounts when we're costing in a manufacturing organisation. Can anyone remember what those costs are, what those accounts are called? Those inventory accounts? They're assets. Yep.
Raw materials, work in progress, and
Great. So materials, it might be raw materials, they might be called materials control account, all interchangeable, work in process and finished goods. So these are all asset accounts, so they're debit or credit in nature. If I want to increase an asset, do I debit it or credit it? Debit, great. So we talked about how the costs flow through these accounts and eventually become, when you sell the goods that you produce, cost of goods sold, which appears on which statement? Income statement, it's an expense. So today we're also going to talk about 2 new accounts that we need when we're doing job costing. And these accounts are temporary accounts, and they're where we accumulate all our costs, our indirect costs. So you need to become familiar with manufacturing overhead control account. It's a temporary account. This is where we accumulate all our indirect costs of manufacturing. And it's contra account, which is the manufacturing overhead allocated. And we're going to refer to these accounts today when we go through this job costing system. And you're going to learn about how, if all the actual costs that we accumulate in this account and the costs that we allocate don't equal, what we do with that difference at the end of the period. Okay, so Why do we have to have costing systems? Well, we all know from week one that we need to come up with this figure, these amounts that appear in these inventory accounts, calculate cost of goods manufactured, which is the cost of the goods that we finished during the period, and then be able to calculate our cost of goods sold. And we need to, for external reporting purposes, only include manufacturing costs in those costs. But there's lots of other reasons that we need to know what it costs us to make our product. We need to know in terms of what it's costing us for the inputs, the materials, how much of the material we use, how much labour we use, what that's costing us, so that we can make plans, budgets, and that we can make decisions to improve processes to increase efficiency. We also need to know what it costs us to make our product so we can price our product so that we can make a profit. If we have no idea what it's costing us to produce, it's very difficult to price appropriately. And then for long-term strategic decisions, it might be that it's costing us so much that we're not competitive and we should stop making the product, or we should outsource it and buy it from a cheaper producer. So there's all sorts of reasons you need to have a job costing system or a costing system so that you can know what it's costing you to produce your product. And remember, we talked about how we're focusing really on manufacturing, but it applies to retail and service as well. They just don't have these particular accounts that relate specifically to manufacturing. Okay, so just a refresher, remember we talked about how if you want to cost something, you first of all have to know exactly what it is that you need to cost. And that's called our cost object. If we don't know what our cost object is, we cannot identify which costs are direct and which are indirect. And that's very important. So our direct costs are those costs that we can trace to our cost object in an economically feasible way. And we talked about the example if we're manufacturing computer monitors, we know that each of them has a screen and we can identify the cost of that screen in an economically feasible way for each monitor. Whereas indirect costs are things like the cost of the electricity for the entire factory, where you may make multiple different products, and so that electricity is an indirect cost. We have to somehow allocate it to that particular product. And to do that, we create what we call cost pools. So this is what this is, a cost pool, okay? So we're creating a cost pool. We're assigning costs to a particular account, and then we're going to allocate those costs to different jobs. But to allocate them, we have to identify a variable that will link that cost to that job, and we call that the cost allocation base. So we want to find whatever drives the cost to move, to change, the cost driver, we want to use that as our cost allocation base. So it might be that, with the example of indirect costs of electricity, it might be that in the factory where you're making lots of different products, we might choose as the allocation base for our computers the square metres of the factory that the computer production takes up as our cost allocation base for electricity. Okay, so remembering with this idea of costing, we're accumulating all of our costs in our accounting system when the transactions occur. And then we're tracing those direct costs to our cost objects, and we're allocating our indirect costs to our cost objects. So you can see we pool all these costs together in an account, and then we allocate those costs to each of the different jobs or cost objects. Okay, so product costing systems all differ depending on the organisation, what the production environment is. So you might be working in an organisation where they have a lot of direct costs and have very minimal indirect costs. So their product costing system may look quite different to an organisation that perhaps is very automated and has very few direct costs, and a lot of their costs are indirect. And so they may have more cost pools. They might have a more refined costing system and use more cost allocation rates than an organisation that has very few or immaterial indirect costs, where they might choose to just use one cost allocation rate. You also have a choice with your cost measurement. Are you going to use actual costs? Are you going to use normal costs? Or are you going to use standard costs? So today we're going to focus on actual and normal, and towards the end of the semester we're going to talk more about standard costs. But we'll give you an idea of what we're meaning by that. And as I said, we're going to learn about different indirect cost allocation methods. Today we're learning the traditional method, which is just having a single plant-wide allocation rate for our indirect costs. But throughout the semester we're going to learn about refining a costing system and creating more than one rate, either based on departments or on activities. Okay, so we all know now that a cost object is a unit or multiple units of distinct product. If we're talking about job order costing, the product tends to be unique or different in some way, and we call that product a job. So examples of a job might be if we make custom-made furniture. For each customer, we'll have a particular job number. If we're building slightly different custom-made houses for our customers, each house will be a particular job number. If we're in a service industry, it might be that we provide security for the Olympic Games, and that particular job will have a job number, etc. Whereas process costing, which we cover in week 6, it's about costing when you have units of product that all look exactly the same. So cartons of milk or barrels of oil, they're all exactly the same. So we don't actually need to create a job for each carton of milk. What we do is we calculate an average cost for the cartons of milk or the barrels of oil. So that's when each product is indistinguishable from each other. So we're going to learn about process costing in lecture 6. It also applies to homogeneous services. So if all your services are exactly the same, we're not going to create a job for each service. We're just going to work out the average cost of each service. So it might be things like, how much does it cost for a bank teller to process a transaction? Okay, so we're talking about job costing. We're talking about if I produce lots of product that is unique or different in some way. The sequence of events for my organisation is that I will receive an order from my customer, I'll schedule my job, I'll order my materials, and then I begin my production. So that job will have a number assigned to it. We need to know 3 things. We need to know what are our cost components for the job. Do we have direct materials? Is there direct labour? What are our indirect costs? We then have to identify source documents for those components because it has to be an auditable process. We have to have a way of recording the transactions so they're somehow linked to a job. And then we have to classify the costs in terms of direct or indirect costs. So we know whether we're going to trace that cost to that job number, or we're going to accumulate the cost in a cost pool and then allocate it to all of our jobs. So I think we're across this. Our direct materials we trace, our direct labour we trace, but our manufacturing overhead we allocate. So the source documents, so for our direct materials, there'll be a material requisition form. So when I am working on the production line, I need material from the stores, I'll send a requisition form with the job number on it to the stores, and when I receive those materials, they'll be added to that job cost record, which is a job cost sheet. So this is a manual system, but it works the same. In a computerised system, it's just, in MyOb, there'll be a job cost number that's attached to each transaction. With direct labour, if you've worked in an accounting firm, you'll know that on your timesheet, you have to account for every 15 minutes of your time by assigning it to a particular client. Okay, so there will be a source document, your labour timesheet. If I'm making something, I might be required to put on my timesheet which job numbers I worked on that day and how long I worked for. And that's how we trace our direct labour to that particular job. And for manufacturing overheads, we pool together all the indirect costs, we calculate an overhead rate, and we allocate based on the use of the allocation base. And that's then added to the job cost sheet. So that's a manual system, but it works the same by assigning numbers in your computerised accounting system. Okay, so a materials requisition might be for indirect materials. That cost of those materials is added to our manufacturing overhead account. The cost of your indirect materials is added to a particular job, which is like a subsidiary account. For your work in process, which is a control account. Does everyone understand what I'm saying when I say subsidiary and control accounts? You remember? So control accounts are the overarching account made up of all the individual accounts. So you'll have an account for each job where all of these costs are accumulated. The costs of all of your jobs will equal your work in process until those jobs are finished, and that amount will be transferred to finished goods. Okay. Okay, so included in the cost of direct materials is not just what you pay for the actual material. You can also include the in-transit costs. So the costs of the initial acquisition plus freight, insurance, storage before it's delivered, less any discounts or allowances. With your indirect materials, indirect manufacturing costs form part of your manufacturing overhead, and you can include that overhead, the purchasing costs, the receiving costs, any inspection you have to do of those materials, or storing, less any scrap revenue. So if you can sell some scrap, you take that off the cost. You'll all be familiar with this. This is the materials cost flow. So you debit your asset account, materials, when you purchase your materials. Then when you use materials, you'll credit the amount that you use, and that is then added to your work in process account. Your indirect materials are added to your manufacturing overhead control account. So in this example, these two accounts are merged. Okay, but I'm keeping them separate on the board because I want later in this lecture to explain to you what happens when what you actually incur doesn't equal what you allocate. Okay? So for the purposes of this example, they've merged the two. And on the left-hand side is the actual, and on the right-hand side, they're crediting what's allocated. Okay, so we've got a lecture example. So I'll put it up on the document camera so that we can move on with the slides, and so you can see the original information. So it's a really simple example. It's about Harrison's Machine Shop, and they produce 40 parts, and all of those parts together are called job number 10. So we've got some information about the beginning balances in these accounts. Materials, we've got 1,200, work in process 0, and finished goods 0. We know that materials and supplies that are purchased equals 65,000, direct materials used is 4,000, indirect is 900, direct labour is 16,000, indirect is 3,500. So we're going to consider the cost flows and prepare the journals for our materials and our labour. So we know when we purchase our materials, this 65,000, we're going to debit materials account, our asset, increase it by 65,000. On the other side of that transaction, We have accounts payable or cash because they haven't told us whether we paid cash or we're buying on credit. Everyone's good? Okay, what about when we use these direct materials? So we know that we used $4,000 worth of direct material. So we're taking that out of our materials control account, our inventory account. So we're going to credit it. So reduce that value in the materials account and we're adding it to our asset work in process. For our indirect materials of 900, instead of going to work in process, we're adding it to our manufacturing overhead control account, which is where we accumulate all our indirect costs of manufacturing. So they're the actual costs. And on the other side, I'm sorry about this, when I put the slides in Echo, all the formatting messed up. This 900 obviously should be over here because this is a credit. So you debit manufacturing overhead control and you credit materials control account. We all good? So that should be fairly simple. So we've dealt with the materials journal entries. So for the labour, remember, we'll get our source document is our labour timesheet. Our direct labour is taken from the timesheet and added to our job cost sheet. Our indirect labour is the amount is taken from our timesheets and added to our manufacturing overhead account. So this would all be automated in your accounting system. Just numbers would be assigned to this information. Okay, so what happens is that for our labour, we're assuming we're not paying it in cash. We're assuming that we've got a liability account called wages payable. And for our direct labour, we'll credit wages payable and debit our work in process. And for our indirect labour, we'll credit wages payable and debit manufacturing overhead control. So see how we've got all your actual indirect costs accumulating in this account. They're manufacturing costs, but they're indirect. We all good? Okay, so as I said, we've got our direct labour. The journal entry is increased work in process, so we debit work in process 16,000 and we credit wages payable 16,000. And for our indirect labour, we debit manufacturing overhead control 3,500 and we credit wages payable. So this amount should be over here. All good? All easy? Okay. So we've done this. We've basically just traced our direct costs to the jobs using the job sheets. What about these overhead expenses? So we've accumulated them, but we haven't allocated them to these jobs. So we've accumulated our indirect labour, our indirect materials, and we'd also add to this account other overhead charges that were indirect of manufacturing, like rent, leasing, depreciation of our plant and equipment, repairs and maintenance, that kind of thing. So we have to have some way of getting these costs and allocating them to our job cost sheets. So we do that by calculating a rate and spreading those costs across all the jobs that have used some of those indirect costs. So we could just get that total overhead cost and divide it by the number of products that we produce. But we learnt last week there's a problem with that, in the sense that if I produce 3 bottles of different sizes on my production line, it may not be that the costs are driven by the number of bottles I produce, but the amount of material in each bottle. So we have to think about what's the allocation base we're going to use that has a relation, a link to the actual change in the indirect costs. So we need to use the most appropriate costing system, the cost driver that has an economically plausible relationship with the change in the indirect costs. Okay, so remember we said you're going to learn about different types of costing systems. So we're focused on job costing, but you can do job costing using actual costs, or you can do it using normal costing, or you can do it using standard costing. So today we're going to do actual and normal. All actual means is that you use the actual direct materials, the actual direct labour, and you create an actual overhead rate. So to do that, you take the total actual manufacturing overhead for the period and you divide by the total quantity of the allocation base. So if we've decided that the cost driver for our indirect manufacturing costs is direct labour hours, then we will use the total number of direct labour hours that we actually incurred in the period. Okay? So first of all, we create the rate, and then we take that rate and we times it by the actual use of this allocation base for that particular job. So if our base is direct labour hours, we times the rate by the number of direct labour hours for that job. Pretty simple? Yeah. Okay, so some additional information about Harrison's. We know that for this accounting period, we actually incurred $585,000 worth of indirect manufacturing costs that we called overhead. And we believe that this cost is driven by the direct labour cost, which is $487,500 for the year. So we can calculate the actual overhead rate by taking the actual manufacturing overhead costs and dividing by the actual direct labour costs. And what we work out is that our rate, our allocation rate, our actual is 1.2 times direct labour costs. So in terms of this job, our overhead, we can calculate the actual by taking that 1.2 times and timesing it by this 16,000. That's all good? So we know the total cost of our job because we have direct materials of 4,000, direct labour of 16,000, plus overhead that we allocate is 19,200. Is that all good? Okay. So you will be required on your online quiz to do a calculation of a job cost, a total job cost. Okay? You probably won't have to do actual, and the reason you won't have to do actual, I'll get to in just a second. So basically, that amount, that 19,200, is allocated, so it's credited and debited to our work in process. So in the case where you're using two accounts, which is my preference, you would allocate from this account. You would do a credit from this account, okay, to work in process, way back here, to add it to work in process, along with your direct materials and your direct labour. Okay, so the example here is that you increase work in process, and because we're just using a single account in this example, you would credit your overhead control, but you'll see what I mean in a moment with the two accounts. Okay, so what's the problem with using actual costing? Yep? Yeah. Yeah, it's too late. You have to wait till the end of the period, till you've recorded all your transactions to be able to allocate your indirect costs to that particular job. And that's a problem if you're trying to price the job. It's also a problem if you're trying to control the costs in that job, because you can't change the process after it's happened. Whereas if you have some idea of what it's costing you as you go, you can perhaps look at the use of the cost allocation base and say, well, why Why are we using so many hours? Why is our overhead so high for this particular job? So it's very accurate using actual costing. You're not going to get a difference between what's actual and what's allocated if you're using actual costing, but it's not timely. So this is where normal costing comes in, and that's what is the focus of what you're going to learn for the rest of today. So normal costing, you still trace your direct costs, they're still actual costs. So you're still accumulating those or assigning those direct costs, the actual amounts to the particular job. But when we allocate, what we do is instead of using an actual overhead rate, we calculate a budgeted overhead rate. So at the beginning of the accounting period, the managers and the management accountant would sit down and make a plan, an estimate of what they think they're going to spend on overhead and calculate a rate. So you still allocate the budgeted overhead rate using the actual use of the cost driver or the cost allocation base for that particular job. And this is where some people get a little bit confused. So the advantage of using a budgeted overhead rate in normal costing is that you can estimate your total job cost sooner, which helps with your pricing. It helps with your decision making about whether to take on jobs or not. It helps with you in planning and also in decisions about how much of a particular input you should use. So to calculate your budgeted overhead rate, and you'll hear it called lots of different things, a predetermined overhead rate, forecast, estimated, they all mean the same thing. So you calculate your budgeted overhead rate by taking your total manufacturing overhead costs for the coming period and dividing that by the estimated total units of the allocation base. Remember, that's your cost driver. You want it to be your cost driver. So it could be direct labour hours, it could be material used, it could be number of units that you produce. Are we all good? Yeah. Okay, so in normal costing, we allocate overhead by taking the budgeted overhead rate times the actual use of the cost allocation base for that job. So this is the actual amount of the cost driver. So same as you did with the actual costing system, all that's different is the rate. Okay? And that's why you can get it wrong. With normal costing, that's why you can get it wrong. Because if you get the budgeted rate, if that estimate's way out, you'll allocate quite a different amount than what you actually incur. And that's what we're going to have to deal with as accountants at the end of the period. So just a quick example. Printers Limited allocates overhead based on direct labour hours. So be really careful. Read questions very closely to find out what your allocation base is. We've got the total estimated overhead for the year, $640,000. The estimated labour cost is $1.4 million, and our estimated labour hours are 160,000. So what's our budgeted overhead rate or our predetermined overhead rate? How do we calculate that? Yep, so we take the estimated overhead of 640,000 and we divide it by the labour hours to get the rate. All good? You're good with that? We don't use the cost because it says labour hours. In the previous example we used the cost. This example we're using the labour hours. So you have to be really careful. All good? Okay. So remembering we're using the estimated cost divided by the estimated number of the direct labour hours because that's the cost allocation base that we have identified. So we've got a budgeted overhead rate of $4 per direct labour hour. So if I'm working on job number 10 and I have 10 direct labour hours, I'm going to allocate another $40 worth of indirect cost to that job. Okay, So we'll just do this quick check and then I'll give you a break. Does anyone have Echo on their smartphone or their smart device? No one's going to. So it's set up so that it's slide 36 and you can work out the answer and hopefully it will recognise your answer on the screen. So it's telling us that job WR53 required $200 of direct materials, 10 direct labour hours at $15 per hour. The estimated overhead for the year was $760,000 and the estimated direct labour hours were 20,000. So what would be recorded as the cost of this job? So the total cost of the job. So please, if you have this capacity, can you choose which is the most correct answer? Yeah? This is in, sorry? No, this is normal because see how it says estimated? Yeah, so we're using it, creating a budgeted rate and we're applying it to the actual hours. All good? So this is a normal costing system. Oh, someone's responded. Makes me happy. So if you don't have this Echo on your smartphone, the instructions are on Blackboard. Okay, well, we find out what this person has. Oh, they got it right too. Fantastic. So whoever responded, thank you, and you got it right. So how do we know it's 730? Well, because it says the cost of the job, we have to include the direct material, which is 200, plus the direct labour, which is 150, 10 times the 150. Then we have to include the indirect costs that we're allocating. So we divide the 760,000 by the 20,000, and that gives us 38, and we times that 38 by the 10, so we've got $380 worth of indirect costs. Add that to the 200 in materials, the 150 in labour, and that gives us 730. You need to be able to do these calculations for your online quiz. Okay? They're not terribly hard, it's just a matter of recognising what the allocation base is. Okay, so I'm going to stop for 10 minutes. Please come and talk to me if you have any questions, and then we'll keep going. Okay, great. Okay, so hopefully you can hear me. No. Okay, can you hear me out the back? Yep, great. Thank you. Okay, so we've worked out with a normal costing system that we are going to allocate our overhead to our particular job using our budgeted overhead rate. And so we would credit our manufacturing overhead allocated account, or in this case, this example, we've merged them two together, and we'd debit our work in process for that amount. So remembering then that flows on to when we finish product, finish our job, that becomes, the value of that job becomes our cost of goods manufactured, which is transferred out of work in process and into finished goods. And then when we sell those finished goods, we calculate the cost of goods sold, and that is transferred out of finished goods, credited and debited into our cost of goods sold account, which is an expense account, which reduces profit. Okay, so the thing about doing actual costing system where you use an actual overhead rate, we know that the advantage is it's very accurate, but you can't calculate it until the end of the period, so it lacks timeliness. It will include cost fluctuations. So perhaps in one period you had higher indirect costs than another period, and that can be problematic for your customers that happen to purchase that particular good in that period and will affect your pricing in that period. So you need to think about that, and that's why organisations do use normal costing, where we calculate a budgeted overhead rate at the beginning of the period, because you can apply that rate or allocate using that rate throughout the period and get a more timely costing of your product with less fluctuation. But the problem is that if you have not been incredibly accurate with your budget, you might have a difference between what you actually paid for overhead and what you've allocated. And we know that if we have a difference, we're going to have to make an adjustment at the end of the period. Otherwise, your costs are going to be inaccurate, but also your assets will be inaccurate. So your assets on your balance sheet, your inventory accounts of work in process and finished goods aren't going to be accurate, and nor is your cost of goods sold. So that's a problem, because we rely on that information to make decisions. Okay. So remember I said to you right at the beginning, we're going to learn about actual and normal today. But towards the end of semester, we're also going to use standard costing. And we're going to use standard costing because we want to be able to do variance analysis. So just to give you a brief introduction, standard costing is where at the beginning of the period you not only create a budgeted rate for your overhead, you also predict how much material you're going to use in each unit of output and how much you're going to pay for those units of material. You predict how much labour you're going to use and what you're going to pay for each unit of labour. And you also create a budgeted rate, but you allocate it based on the standard use of the allocation base. So basically, standard costing is where at the beginning of the period, you budget everything about what is going to go into each unit of your product. And the purpose of standard costing is so you can compare those standards against what you actually achieve, so you know if there's a difference between what you set out to do and what you actually did. Is it because I paid too much for my material, or is it because I used too much material? So it might be a price variance or an efficiency variance. Same with your labour. Is it because I paid too much or because I used too much labour? Or with your indirect costs, is it because I got my budgeted rate wrong, or I spent much more on my overhead than I intended, or much less? Or is it because I used more or less of my allocation base? So you can imagine if my allocation base is direct labour hours and I predicted I was going to use 10 per job, but I actually used 12, that's going to mean that I have got a difference between the budgeted costs, my standard costs, and what I actually achieved. So you don't have to worry about this for the purposes of your online quiz, but you do need to start thinking about it in terms of later on in the semester. So we're really focused on these first two, actual and normal costing. The only difference between actual and normal costing is the rate that we use to allocate our overhead. Okay, so in that last example, we used a single rate. We just worked out one overhead allocation rate. But in the real world, companies can use multiple rates based on different departments, and we're going to cover that next week. Or they might use separate rates for different activities because they're really interested in knowing and managing the activities that use resources that drive their costs. So we've just used a single plant-wide rate today, which is often referred to as traditional costing. Okay, so next week we're going to be talking about this department, creating department rates and then allocating those rates using the allocation base for each department. So it's just a little bit more complex, and we refer to it as cost system refinement. So if we think about how potentially using normal costing and a budgeted overhead rate can lead to either over-allocating or under-allocating overhead, and how at the end of the period we might have to make an adjustment because what we actually incurred in overhead differs from what we've allocated. So in this example, Calvin Company's actual overhead was $650,000 for a total of 170,000 direct labour hours. But what was applied, and you can use the term applied or allocated or absorbed, what was actually applied to the jobs during the year was applied or allocated using a predetermined or budgeted overhead rate of $4. So we've allocated 170,000 times 4. Our actual is 650,000. Okay, so there's a difference. So we've allocated 680,000. Our actual is 650,000. So what we say in that case is that we have over-allocated by 30,000. Does that make sense? What will be the effect of over-allocating on our profit? Less profit, fantastic. You'll have a bigger cost of goods sold, but you'll also have, potentially, if you haven't sold everything that you've made, a higher asset value on your balance sheet than actually is the case. So that's a problem. So we have to make an adjustment. Did everyone get that? So if we over-allocate, we potentially have too much expense and overstated assets and less understated profit. If we under-allocate, so if our actual overhead is higher than what we've allocated, then we've understated our expenses, overstated our profits, and understated our assets. Okay, so we make adjustments. So if we what can occur if we under-allocate our indirect costs? That happens when the allocated amount of indirect costs is less than the actual. Over-allocation is when we've allocated more than the actual. And we can calculate it very easily. It's the difference between what you actually incur and what you allocate. And we also can use the term under-applied or over-applied or under-absorbed or over-absorbed. It means the same as under-allocated or over-allocated. So in different textbooks, you'll see different terminology. Okay, so with this particular job, we've got a job number 100, and this company manufactures various sporting equipment. It's planning to sell a batch of 25 special machines to a gym. The direct materials are 45,000. The direct manufacturing labour is 14,000. They use machine hours as their allocation base for linking their indirect manufacturing costs to jobs. And this particular job used 500 machine hours, so that's the actual use of the cost allocation base. Assume the budget, 60,000 for the total overhead costs, and the budget for the machine hours is 2,400. So we can calculate a budgeted overhead rate by dividing 60,000 by the 2,400. So we've got $25 per machine hour. How do we allocate it? If we're using normal costing, we take that budgeted rate and times that by the actual machine hours used for that job. Make sense? And then we have to add that to our manufacturing labour and our materials to get the total cost of that job. So we're allocating, taking the actual number of hours by the budgeted overhead rate, so that's 12,500. Our materials were 45,000, our direct labour was 14,000. We've allocated 12,500. So this is the cost that we have calculated for this job using a normal costing system. It might have been different if we'd used an actual costing system, because we don't know that our budgeted overhead rate is accurate. And you won't know that until the end of the year when all of your indirect costs have been accumulated in your accounting system. So assume then for that job that 2,480 machine hours were actually used by all the jobs. Remember, we predicted that they were going to use 2,400 machine hours. That was our budget. But they actually used 2,480. And the actual overhead was 65,100. So that's what they actually used. It differs from what was budgeted. So the amount that we allocated to all the jobs was 62,000 because we allocate based on the actual number of machine hours at the budgeted rate. Is everyone still with me? Okay, so we can work out whether we've over or under allocated by taking the actual and taking off what we've allocated. And so we've under allocated $3,100 worth of cost. So we've under costed our partly made goods, our finished goods, and we have potentially under expensed our cost of goods sold. So quick check, I'll just wish that would go away. Okay, Tiger Inc. had actual manufacturing overhead costs of 1.21 million and a predetermined, that means budgeted, overhead rate of $4 per machine hour. Tiger Inc. worked 290,000 machine hours during the period. So we should be able to work out whether we've over or under allocated the overhead. So what would we do first? We want to work out how much we're going to allocate. We know our overhead rate is $4, and we know we've actually used 290,000 machine hours. So we can calculate how much we allocate. And then we want to know what the difference between this and this is. Oh, we've got two answers. That's great. Okay. So, oh, they're both correct. So they're underallocated by 50,000 because if you times 4 by 290,000, that's what we've allocated, and that is equal to 50,000 less than the actual incurred. Is all good? Fantastic. Does anyone have a question about that? So it seems really simple now, but lots of people don't get it completely correct. So underallocated just means that what you've allocated is less than what you actually incurred. And it's because you've got the budgeted overhead rate wrong, or you've got the budgeted, or you've used more or less of the actual allocation base. Yep. There's less overhead that's been allocated to those partly made goods. Yeah. Yeah. All good? Sorry. Yeah, because they're inventory accounts. Yeah. Sorry? Yeah, so that's, so in this question, we're assuming that machine hours are your allocation base. No, because it's worked, it's actual. That's what worked means. It's actual. Okay? Have you got it? All good? Okay. So if we underallocate using a normal costing system, it might be because the numerator in your budgeted overhead rate is wrong. The actual manufacturing costs are more than we've budgeted. The denominator might be wrong, but the actual machine hours or whatever the cost driver is are less than the budgeted amount. So if we underallocate, it means our budgeted overhead rate is too low. So that's either because the numerator is too low or because the denominator is too high. That make sense? And the reverse is true for over-allocation. So if we over-allocate overhead, it can be because our budgeted overhead rate is too high, which means that your actual manufacturing overhead costs are less than budgeted, or your actual allocation base is more than your budgeted amount. So your denominator is too small, so your rate's too high. Okay. What do we do? If we've got a difference between what we actually incurred and what we've allocated, we have three options to make an adjustment for that difference. The first one is an adjusted allocation rate approach, where you just go back in your accounting system and you use the actual rate instead of the budgeted rate. So everything is fixed. Everything is accurate. Okay? Or you write off the difference to cost of goods sold, which is not very accurate, but it's simple. And if it's a very immaterial amount, it's certainly going to increase your expense in this period and reduce your profit in this period. But if it's an immaterial amount and the auditors aren't going to get upset about it, that is a quick and easy way to do it. The third one is a proration approach. And all that means is you split up the difference between allocated and actual between your asset accounts, work in process, finished goods, and cost of goods sold. Because remember we said, if you over or under allocate, these accounts will be stated incorrectly because they're inventoriable costs, and so will this expense account. So we're going to split up that difference between those three accounts. Okay? So that, yep. Yep. You have to be consistent. So, and this is often a theory question. This method is the most accurate. This method is the simplest and least accurate. And there's two proration approaches, one of which is more accurate than the other, and we'll talk about that now. Okay, so as I said, to adjust the allocation, you just get to the end of the period, work out the actual allocation rate, and you reallocate. And that's simple in an accounting system. You're just using the actual rate instead of the budgeted rate, and so you're going to get it right. So that's very accurate. This system is where you just write off that difference between actual and allocated to cost of goods sold. And if it's not a very material amount, it's a simple system, but it's not terribly accurate, and it's going to overstate your expense in the period and reduce your profit. And it'll understate your assets. You can then also choose to prorate. That just means you're splitting up this 3,100 between these asset accounts and this expense. You've already allocated some overhead to each of those accounts, and you're just adjusting that. And you can do it either, you can do it either based on their ending balances or on the amount of overhead that's already been allocated to them. So if we're writing off just to cost of goods sold, it means the difference between what's actual and what's allocated is added to your cost of goods sold in this case, because what's actual is higher than what you've allocated. Does everyone understand that? So we've under-allocated. So that means the journal entry at the end. So if you have, this journal entry relates to two accounts, the overhead allocated account and the overhead control account. In this example, it's just been merged together. So, oh no, non-permanent marker, great. Okay, so that's not going to come off. Great. Okay. So In this example, we've got 65,100 is the actual in our manufacturing overhead control account. In our allocated account, we've got 62,000. So this is what we've allocated, this is what we've actually incurred. At the end of the period, we have to close those two accounts off. Remember I told you it was a temporary account? You have to close it at the end of the period, and they don't balance. So in this case, we're going to write off the difference to our cost of goods sold. Okay, so there's a difference of 3,100. So we're going to credit manufacturing overhead control, debit our manufacturing overhead allocated, and the difference we're going to debit to cost of goods sold. So our balance in these accounts is 0. They're closed off. This is a closing entry at the end of the period. Does everyone understand that? So during the period, we've accumulated these costs, these actual costs, we've allocated these costs. At the end of the period, we write a journal entry to close this account and close this account, and the difference using the write-off to cost of goods sold approach is put to cost of goods sold. So in this case, I have underallocated, so I'm increasing cost of goods sold by the difference, so that my allocation equals my actual. Okay, so if I'm using a proration approach, I can either split up that 3,100 between work in process, finished goods and cost of goods sold using the total amount of the manufacturing overhead I've already allocated to those accounts, or based on the ending balances in those accounts. The difference is that the ending balance will also include direct material and direct labour. So this approach B is not as accurate as approach A. Okay, so approach A, this is the overhead that we've allocated already to each of these accounts. All we do is create a weighting. To do that, we divide this amount by the total overhead in all of those accounts, and we get a percentage. We times that percentage by the 3,100, and this is how much we're going to add to work in process. We underallocated, so we're adding more in. All good? I'm sorry about this, it's echo, it's mucked up my formatting. Okay, so all we do is add these together, divide this by this, and that gives us the weighting. We apply the rating to the difference, the underallocation, and that gives us how much we're going to put to work in process. And then we do exactly the same thing to finished goods and cost of goods sold. But this column is just the amount that we've already allocated to those accounts. Approach B, we use the ending balances and do exactly the same thing. So that it also includes direct material and direct labour. And we work out these weightings, times that by the amount we've underallocated, and we can work out how much we're going to allocate to these accounts. So see this ending journal entry, instead of just closing off overhead allocated and control to one account, we're splitting it between the three. Does that make sense? So it's more accurate. So we're not going to be understating our assets and our expense as badly as we would have if we've just written off to cost of goods sold. Okay. So that's just the T accounts demonstrating that proration. Proration just means splitting up using a ratio. Okay. So remember, to choose amongst these approaches, they all have different levels of accuracy. The most accurate is to use the adjusted allocation rate. So you work out the actual allocation rate and you go back and you redo all of those transactions for all of those allocations. Approach A of proration is more accurate than approach B, and the immediate write-off to cost of goods sold is the least accurate but the simplest approach. So if you have an immaterial amount, it may not be worth your while doing either of the other approaches. Okay, so this last question for you. If the balance of manufacturing overhead allocated account, so this is how much you've allocated, is $9,000, and the balance of the manufacturing overhead control account is $8,500. So this is actual, that's what you've actually incurred. This is how much you've allocated. What's the journal entry to close the overhead accounts to the cost of goods sold account? Remembering that we're closing the accounts. So the overhead control account is debit in nature, the allocated account is credit in nature. So to close them off, we need to do the opposite. So we've allocated 9,000. The actual is 8,500. So we've got a $500 difference between what we actually incurred and what we allocated. And we have over allocated. Has anyone got a tent? Yeah, see? Fantastic. I don't know what's happening with the doesn't seem to want to work. Nope. Okay. So the answer is C. Okay, why is it C? Because what we would have had in control account would have been 8,500 and we would have had 9,000 here. So to close it off, we have to credit manufacturing overhead control, 8,500. So we get a zero balance. And we debit manufacturing overhead allocated 9,000. So the difference is a credit to cost of goods sold. So it's C. What's the effect on cost of goods sold of crediting? Reduction? Great. Okay. Thank you very much. No lecture next week. It'll be online. So I'll see you the following week. Thank you. Hello.
I still don't figure out why the approach A is more.
Yep. Okay, so approach A is using the overhead that you've already allocated. Approach B is using the ending balance. So the ending balance also includes direct material and indirect labor. So it is not as accurate as just apportioning based on this already allocated amount of labor. Because direct material and direct labor may not be driven by the same cost driver.
So maybe if there's any exams, just two option to choosing. So you just choosing A instead of B.
Yeah, using overhead allocated is more accurate than using the ending balances. This is easier because you don't have to go back and trace what's overhead and what's allocated. You just can look at the
Using
ending
the ending
balance.
balance and then just chasing the balance.
Yeah. it's a temporary asset. So the manufacturing overhead cost, the actual control account, is debit in nature. So it's like an asset. The allocation is a contra account, so it's credit in nature. And that's why when you close them off, you credit your overhead control and you debit your allocation. Sorry? Yes, not allocation. Allocation is credit, control is debit. So manufacturing overhead control is an asset. You're accumulating all of your indirect costs in there, they're your actual costs. You have an allocation account that you keep separate where you credit all the allocated amounts. So they're offsetting. Yeah? Yeah. Does that make sense? It's like having an asset, property, plant, and equipment, and it's an offsetting account.
So why control is actually a passive asset? I mean, like the allocation is like a cost picture, right?
Yeah, except that they inventoriable costs. These costs can be included as part of your working process and your unit costs. So you just accumulate them in an account. Yeah? Your indirect account. They're temporary, they go away. Just close them off. It's just like a cost. Yeah.
Something control is something like that is an asset.
Yeah, no. Control just means it's the account, all the subsidiary accounts are added together. That's all control means. You have multiple subsidiary accounts beneath that. So you can have an account just for electricity, an account for all the other indirect costs, and they all get accumulated to your overhead account. Whatever.
Now, I'm really
Subsidiary account.
that means that subsidiary account.
But when they're manufacturing companies, some costs are inventory. If they're manufacturing costs, they're inventory assets. Because they're part of what you make. And what you make is the asset until you sell it. Then it's expensed.
Oh, right.
Yeah. Does that make sense? Okay, so what you're saying, what I'm saying is that we take what we allocate, because it comes to, when you allocate, you take money out of allocation and putting it into an asset. When you allocate, you have one side of the transaction is manufacturing overhead allocated, the other side is work in process. Because you're taking those indirect costs and allocating them to a job. It's a bit tricky, but you'll get it. It's just a matter of practicing some questions. Does it make sense? Yeah. Hello, how are you doing? Yep.
It's just the first 4 weeks.
Yes, that's right.
And there's 12 questions on the
The electric example in terms of the cost of goods manufacturing control is very good indicator. So you'll have multi-choice, 16 multi-choice, and then you'll have 3 conditions. Short answer, not written, but you'll have to compare it from a good manufacturing control, and then have a theory around that. And then you also have a question on job costing and a question on compartmenting that are written. No, well, the alternative is to have a mid-semester exam where everyone turns up on Saturday morning. So I was tossing up. So it's only like 20%, whereas normally everybody gets to get 40. So it's kind of, and also open book, because you're doing it at home or wherever you want to do it. So it's kind of more of a learning. So my tip in this role, becoming everyone, is to do the work in on a piece of paper type thing. Yeah, that'll be the quickest for you. And try not to sit there. Yeah. Does that make sense? Yeah. Yeah, cool. Hello. Yes. Yeah, so that was the actual cost there. That was sitting in there. And just give it there's two accounts. There's the control account and the allocated account. The allocated account is for credit. So you have to debit it and close it. But they're going to balance. There's a difference of 3,100. To make it balance, you have to debit. And that, in this choice of how you write off, you take difference. You're debiting into the normal stock. That's the simplest way. So this is a closing entry. I'm closing off manufacturing allocated from manufacturing stock. So they're going to zero balance. Difference between those two is going to be
Hi, I just want to ask another difference between FH control and FH.
okay. So the FX control is where all your actual costs are. Allocated is when you work out the allocation rate and you allocate costs to your working process. Okay?
This is like budgeted.
Yeah. Yeah, and that's why there can be a difference. Go good? If you use the normal costing, you will use a budgeted rate and you can get it. If not, you never know. Hopefully you're accurate, but there might be a difference. Yeah.
Almost.
Yeah. Don't worry, I'm never going to get this. Oh, okay. Just because they didn't tell us if we pay cash. Okay. So for labour, when you pay go pay someone, if your time sheets are for every 2 weeks, so the time period finishes on Friday, but you don't pay them the next week, then create a liability for wages payable on that Friday, and that's basically what's happened here. We know that there's labour that's come into that job, and on the other side of that is that we have a liability that's taken from that to our workers. Yeah. If you physically pay it with the cash. Yeah.
So this is off labor cost?
Yes. No, wages payable when you actually pay the cash for closing costs. The liability. Keep going. I'm just going to see if I can get this writing correct.
I think we can just think the allocation like a write-off, right?
You can think of it as, sorry?
Like an allowance, which you will close investments and you have projected.
Yeah, you can think of it
Like a
like,
bad debt.
I don't know exactly how much my indirect costs are going to be, so I'm predicting it. I'm predicting it during the period. I'm adding it onto my working process, just about